What's going on YouTube? If you're new here, my name is Juliette Robelo and I'm a realtor and investor here in Orange County, California. What a roller coaster, you guys. It has been such a crazy week, ranging from dread to euphoria, then terror, then elation, all to settle at confusion and uncertainty. Not just in markets, but everywhere, from tariffs to groceries to jobs. Let's recap what happened this last week. We started the week with news of reciprocal tariffs.
As they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything, but now we're going to charge.
Then a pause on those tariffs, but not a full pause, because instead of reciprocal tariffs, we now have a universal 10% tariff for all countries, except China. But for those countries who are not China, there are exceptions to the universal 10% rule. If you're a foreign country exporting cars or carports, those are still subject to a 25% tariff. Oh, and another exception. Goods from Mexico and Canada that aren't USMCA compliant don't get the 10% reprieve. They're still subject to a 25% tariff like steel and aluminum. Then there's China, a 145% tariff on nearly everything coming out of China, except as of Friday night, phones and electronics are exempt, not just from the 145%, but also from the 10%. Oh, and the phones and electronic exemption doesn't just apply to China. It applies to everyone else who is not China and on the 10% tariff rule. Did you catch all of that?
What do you mean by that?
So yeah, it's a lot to keep up with because the information keeps shifting. And I think a lot of people, including myself, are thinking, okay, I'm just gonna stock up on whatever I might need later. Toothpaste, maple syrup, electronics, anything that might get tariffed. And the stock market, all over the place. What about that 9.5 nonsensical rise in the S&P on Wednesday afternoon when the Treasury Secretary put a pause on reciprocal tariffs?
A 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation.
That announcement resulted in the third biggest one-day gain in US history. Honestly, it made no sense in the face of all this instability and confusion, which is why some people are calling that rally suspicious. There's already talk of insider trading and market manipulation because some people just happened to be perfectly positioned for a call up minutes before the announcement, and at a point when the market was clearly failing, they made an absolute killing. And some people are calling it the tariff pump and dump. And guess what? One of the top beneficiaries was Donald Trump's close friend, Charles Schwab, the individual, not the company, who supposedly walked away with over $2 billion on a trade that made no sense in a market headed for a meltdown. But the market could only defy logic for so long because the next day the SPY was down again. Okay, so let's go ahead and talk about my trading plan for the week. So considering everything that happened last week, the tariffs, the escalations, the president's capitulations, possible market manipulations, oh my God. So I need to recalibrate my approach to the stock market. So here's what I'm thinking for the week of April 14th. For those of you who know options, I'm doing a straddle play because I know the market's gonna move, but I don't know what direction. The straddle lets me profit from volatile swings, so I'll be doing that for some short-term money. Secondly, I'm not buying the dip. I have to say, I don't think the stock market has hit its bottom yet. So while you might hear that it's a great time to pick up some stocks at a discount, I don't think that it's true for our traditionally sexy stocks, including the Mag 7, which, if you didn't know, include Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Even before this whole tariff fiasco, it kind of felt like we were living in a fake economy. What I mean by that is the stock market's been hitting record highs, but not because companies are adding real value. It's been driven by what Warren Buffett called casino-like behavior in the markets. And that's not a good thing, because when stocks are being held up by fear, greed, or trendiness and not by true fundamentals, it's only a matter of time before they fall. That kind of momentum just doesn't last. So yeah, I've been getting recession vibes for a while now, But I think this whole tariff situation just sped things up. We're not inching towards a slowdown anymore. We're crashing into it. At least that's my humble opinion. Practically speaking, I think the wound to our economy is deeper than people realize and want to accept, which means growth stocks aren't the move, at least not until we get through this hump. And that might take us to the end of the year, maybe longer. Now, I'm not saying I'm divesting completely from US stocks. I'm just being way more selective about where I put my money. So here's what I'm looking at. Now let's talk about a stock you all know I love, Rheinmetall, Germany's largest defense manufacturer. So here's why I like it. The world order is shifting and Europe is facing a daunting reality. We're pushing them to be on their own. For decades, Europe has relied on the US for protection. But now, with the current administration pulling back its support, both financially and strategically, the message is clear. NATO countries need to start funding and defending themselves, period. So in response, they're ramping up their military budgets, forming new partnerships, and pouring money into their domestic defense manufacturing. Rheinmetall is at the center of that. The post-World War II restrictions that limited Germany's defense investments have been pulled back. And since then, Rheinmetall has been securing massive contracts across Europe, from tanks to ammunition to advanced military tech. This is no longer just a defense stock. It's a geopolitical repositioning play. I believe that Rheinmetall still has plenty of room to run. And as you know, Putin tried to assassinate Rheinmetall's CEO, so it has that added cachet to it. Now, if you're not into stock picking, or if you just want to diversify your exposure, there's a really smart alternative. European defense ETFs. The one I've been watching is the Wisdom Tree Europe Defense Fund, WDEF. It includes companies like Rheinmetall, Leonardo, Bay Systems, Saab, and other major players that are benefiting from Europe's military buildout. So instead of just choosing one stock, you'll get a broad exposure to the entire European defense sector, all in one fund. To me, this is a way to profit from a major realignment that's unfolding in front of us right now. And look, I'm not saying war is good. I'm saying governments are reprioritizing and money always follows policy. If Europe is going to spend the next decade building a defense infrastructure that's independent from the US, I want to be holding companies that's making that happen. So that's how I'm playing it. Rheinmetall for direct exposure, and WDEF if you want a more diversified, balanced approach. Next, I'm loading up on more REITs, specifically AGNC. Throughout all of this volatility, AGNC has held up surprisingly well. Over the past couple of months, during some of the most unpredictable market swings we've seen, its stock price has fluctuated between $7.85 and $10.85. That's relatively stable for this kind of market. And here's the thing, when AGNC dips to the lower end, say around $8, the dividend yield actually increases. Right now, with an annual dividend of $1.44, that puts the yield at around 18%. So lower prices, they're not scary. They just mean a better payout. AGNC has paid monthly dividends like clockwork since 2008. Right now, it pays 12 cents per share per month. So if you're holding 1,000 shares, that's $120 in monthly income. And I'm not the only one leaning into REITs. If you've been skimming Bloomberg, The Economist, or even Yahoo Finance, you've probably noticed it too. A lot of analysts are recommending REITs as a way to generate income while the rest of the market shakes itself out. With all the uncertainty around rate policy, earnings, and tariffs, REITs offer something people really need right now: stability and cash flow. It's not flashy, but it's reliable. And honestly, that's exactly what I'm looking for. Next, I'm adding gold to the mix. As markets rise, gold keeps climbing, hitting new all-time highs this past week. And that's not random. Gold is one of the oldest signals we have that investors are bracing for trouble. Whenever uncertainty increases, whether it's war, inflation, debt ceilings, tariffs, or central banks behaving unpredictably, money flows into safe haven assets, and gold is the classic go-to. So while gold's rise is partly about performance, it's also an economic signal. It's telling us that confidence is fading. Now, if you're not into the idea of holding a physical gold bar, there's other ways to get exposure. One option I like is IAU, BlackRock's iShares Gold Trust. It's a super accessible way to own gold without having to deal with gold bars, coins, and secret vaults, because where are you gonna hide your gold? As of Friday, it was trading at around $60.96. So it's not too expensive and it's backed by actual gold reserves. But there's another angle too, one that could bring you higher profits. Gold mining stocks. These are companies that make their money from extracting and selling gold. So as oil prices decline, so do the operating costs for mining. Less money spent on gas means higher margins, even more so if gold prices continue to climb. So now you have a recipe for potentially significant gains. Lower costs plus higher gold prices equals stronger earnings, which often means higher share prices. So here's a few mining stocks that I have on my radar that are still trading at relatively accessible levels. So we have Barrick Gold at around $20.59, Core Mining Incorporated trading at about $5.92, and Newmont Corporation, one of the biggest players, currently trading at around $54.97. Each of these gives you exposure to gold with the added potential of operational leverage, meaning if gold prices stay up and their costs stay down, these companies could rally to new highs. So whether you're looking for stability with IAU or growth potential with mining stocks, gold is back on the map. And it's not just a defense move, it's a smart one. So if you're paying attention to things, you're probably a little worried like I am, but that's why I'm here to give you what's gonna help me through these difficult times. I'm not gonna overreact, but I am gonna position myself for the future by staying clear-eyed, strategic, and forward-thinking. Thank you guys so much for hanging out with me today. If this gave you something to think about, or if you have your own ideas brewing, drop a comment below. I'd love to hear what moves you guys are making in this market. And last but not least, don't forget to like, subscribe, and share this video if you found it helpful. And what else was I gonna say? Oh, and I post every Sunday, so stay tuned and turn on your bell notifications so that you can be notified every time I upload a brand new video. Stay smart, be curious, and build wealth. I'll see you guys next time. Have a wonderful week. Bye.